Hello guys, welcome back, and today we're going to talk about responsibility accounting. Now, responsibility accounting is a term we use to describe decentralized of authority, in which that we have all these managers, all these divisions, all these divisions. So you need to know what the manager has control of and what performance indicator that we can use to measure their performance. Now, a cost center is when that the manager has control over the controllable cost, in which that it is the non-fixed cost, and we use variance analysis or efficiency measures. Revenue centers, we calculate revenues, so that's the only way we can use to find the performance, and of course manager will always has control over the revenue. Profit center, they can control over the controllable cost and the sales price, including transfer pricing. In which that how can we measure the performance of the managers is by checking their profit. Contribution centers, now for you that do not know contribution center, contribution is when we take the sales and we divide it with the manageable controllable costs, in which that we do not, after we take the sales and minus with the controllable costs, that's when we call as contribution minus with the fixed cost, then it will become a profit. Then it will become a profit itself. Like investment centers, we have to check at every single thing, the investment, the assets, the working capital, the controllable costs, and then we need to see the ROI, the residual income, and any other financial ratios of the all the different types of 5 financial ratios. Now let's try some questions to further understand this topic, in which that we have to understand the essence of this topic is to see whether the division is performing well or not. Now, return on investment shows how much profit has been made in relation to the amount of capital. Profit over capital employed times with 100. Okay, so first of all, we always have to take the profit, 60,000, divided by capital employed, and then we have to check the ROI. So let's try to do that question. So to do that question, 60,000 divided by 400,000. 60,000 divided by 400,000. And we have okay, my bad, but then we should be having 60,000 divided by 400,000 and 0.15, we times it by 100, so we get 50%. That is the ROI. Now for B is 30,000 and 120,000, so we just take 30,000 we divide by 120,000 and then times it by 100, and there you go. Times it by 100, there we go. So 25%. So that is, after we've calculated the ROI, we can see that division A is actually doing better. However, to fully answer this question, we also need to explain. Therefore, we can put it in percentages such as investment center A has made double the profits of investment center B in terms of profits alone. So investment A has much lower ROI, therefore B has been a more successful investment unit. Right, next question. Behavioral implications lead to no generally method of calculating ROI and okay, so let's take this question. Let's try to do profit after depreciation as a percentage of net asset. Right, so for this particular question, we have a non-current asset, 100,000, depreciation of 20 every year, so net book value is 80. The working capital that we put in is 10, and the capital employed is 10, so profit is 10. So how do we answer this? It would be so to find the ROI, we just take the profit and then we divide it by the capital employed, which is 90. However, there are some implications of measuring using ROI, simply because we look at this particular investment P and investment Q. Both of them have the same non-current asset at cost, in which was 230,000 each. However, because of depreciation, investment P has actually accumulated depreciation more than investment Q. Therefore, the net book value will become 60. So when we take the capital, working capital plus with the net book value, it become 80,000 equals to 80,000 is the capital we employed. So then we take the profit of 24,000 and we simply divide it over 80,000 and we get 30%. However, let's look at investment Q. Investment Q is when the working capital is 20,000, the NCA at cost is 230,000, the same as with investment P. However, it has only been depreciate only 10,000, so that means it's a very new, it's a fairly new product. So because of that, the net book value is high, and because of that, the capital employed will be high. So when the profit of the same of 24,000, we divide profit with the capital employed, we actually get only 10%. Even though the working capital is the same, the net book working capital is the same, the NCA at cost is the same. I would say the rate of depreciation might also be the same. The profit is also the same. However, the difference in ROI simply because the age and the time of accumulated depreciation incurred. So if we try to explain this, investment P and Q have the same amount of working capital, the same value of non-current asset, and same profit. However, P's non-current assets have been depreciated by a much larger amount simply because P may have hold the asset for a longer time than Q. Therefore, P ROI is 3 times the size of Q. Conclusion therefore might be P has performed much better than Q. However, it won't really be fair simply because we actually need to compare them when they are around the same age. Therefore, ROI is a flawed technique to ROI is it's one of the best way to find. However, there are still flaws in measuring the performance of the division. So consider some investment base. Also, we have to look at how the investment should be valued. If manager's performance is being, and this is we're talking about investment base. If a manager's performance is being evaluated, only those assets which can be traced directly to the division. So therefore, if we have 3 divisions inside a particular building, however, all the computers inside that building can be directly traced into the computer departments, then and are controllable by the manager, then it should be included. However, if the computers are not by the computer division, then we should not be including it. Performance of the development center is being appraised. Portion of the investment should be included. Alright, profits. Asset base, but what about profits? Profits of investment center is being assessed. Performance investment center manager is being assessed based on profits, ROI. So let's just take this. Take example, center A has asset of 1 million, expects to earn profit of 400,000. How about if they want to review a new capital investment equals 250,000? They want to increase the 250,000 on top of the they want to increase the 250,000 on top of the 1 million asset, and they want to see the ROI. Alright, let's see. This member actually reduce incentive simply because we take the profit, we divide it by capital employed, and then we get 40% solid. However, we take the new investment of 400,000, and the new profit of the investment 400,000 plus with the profit of 750,000 per annum, and then we divide it over capital employed of 1 million plus with 250,000, we will actually see a decrease in 38% to 38%. So therefore, if we are a new company, then we will actually not take the new investment. However, if this particular center A is part of a bigger group and the target ROI is only 25%, then we should actually take the new investment, simply because if we were to see the new investment on itself, 75,000 divided by 250,000, this new capital investment will actually have a 30% increase, not including the previous investment and profits. So therefore, and it will actually have a additional 75,000 revenue. So if for a divisional manager, we actually have to look what's best for the company itself, simply because if they are trying to look at it from a one perspective of the overall division, you will have a decrease in ROI of 2%, which is not good. However, if we were to look at the return of investment from this particular investment itself, and from the overall increase of profit for the company, which it has the increase of 75,000, then yes, Center A would take the investment. So that is all for ROI. So yeah, that is all for ROI. See you next time.